I believe this stock market rally will break records, and I even think the most bullish of bulls will be proven wrong about how much this bubble will inflate before it ends up popping. And that's for a variety of reasons, but we can start with the fundamental issues that do exist in our economy and in our stock market today. For example, the federal government's outstanding debt and how it's ballooning right alongside the amount of interest payments that the government is paying to service that debt. For the last couple of years, this chart here has been making the rounds on social media, primarily from the bears that talk about this doomsday or how we're on the verge of a Great Depression and things are about to break. But they're forgetting an important piece to the puzzle that I think is very, very important. This chart shows that the federal government's debt and the interest payments on that debt are on unsustainable paths. This is an ugly chart. These are ugly numbers, but it can be sustained much longer than people think. And that's for one reason that I think is very important. When we think about who owns the federal government's debt, it's American corporations, and it's also American consumers. If you have a high yield savings account anywhere, chances are you own the federal government's debt. That's how you get a risk-free high yield. Like if you have an account at Robinhood or Ally Financial and earn high yield on your savings, they're buying government debt for you. You also have corporations like Apple, Microsoft, Warren Buffett's Berkshire Hathaway, who buy United States treasuries and treasury bills and treasury bonds, which is them buying the government's debt. Why does this matter? It matters because as interest payments balloon, the money that's being put directly into American corporations and American consumers' pockets also balloons because they own the debt. So you can see that this is kind of a snowball that will grow bigger and bigger and bigger, and it's hyperinflationary over time, and that's how this thing will end up busting or something will end up breaking, where we have a hyperinflationary spell that forces the federal funds rate to rise to double digits, which would be restrictive to the economy and would hurt the economy, unlike the current 5% federal funds rate. And that's another problem that exists today. The Federal Reserve seems to be blinded about the upward pressures on inflation right now. They decided to go with a jumbo rate cut of 50 basis points, and they're likely to cut interest rates again before the end of this year when inflation has a lot of upwards pressure being put on it and growth in the economy is actually above average. Real GDP continues to set record highs. In no way, shape, or form do we have an economy right now that needs the extra push at its back. I don't know if Jerome Powell is trying to cement his legacy as a positive one as the leader of the Federal Reserve by cutting interest rates and making sure, absolutely certain, that we don't have a hard landing after raising interest rates. I don't know what's going on, but we need to recognize this as investors, because if you don't recognize it, you will be left behind. This is something we identified in late 2022, and we have been buying stocks, and our portfolio's done tremendously. I have a screenshot that shows it here. We're up 148% just since the end of 2023. If I go back to the end of 2022, this looks stupid. But since the end of 2023, my portfolio is up 148% compared to the NASDAQ's 36%. But the sad part is there's people that have been left on the sidelines because they've been convinced about this doomsday and Great Depression happening very, very soon. And all of a sudden, they decided not to have any exposure to assets, and they've been left behind. So if you leave this video with one message, let it be that. You have to have exposure to assets, otherwise you will be left behind. I do my best to share what I'm thinking and what I'm doing and my analysis of the stock market and the economy, my research. I share it with my paid monthly members. I'm entirely self-funded and I'm independent, so your monthly support means a lot to me. Just the fact you're watching this video means a lot to me, but if you want to take that extra step in supporting me and getting access to basically my brain, consider joining that membership by hitting the Patreon link down below or the join button located right next to the subscribe button. You might as well subscribe and hit the like button while you're down there as well. But let's get back to this video. The problem exists that the Federal Reserve is ignoring the upwards pressures on inflation right now. This chart here shows you CPI services versus CPI goods. CPI goods have been flatlining and actually deflating for the last couple of years. That's for a variety of reasons that I've discussed previously. But what's more important is that services inflation continues to tick higher and higher and higher and higher. And this is not a good thing. This is not a good thing, especially if the Fed wants to further stimulate the economy. I know you all have experienced it. Whatever you're subscribed to on the internet, you've probably seen the price of your membership or your subscription go higher just recently. I mean, I've had Netflix go higher. I've had my YouTube membership, my YouTube premium subscription, the price of that go higher. I've had my subscription to Adobe for Photoshop and Adobe Premiere, which is what I used to edit my videos. That subscription got more expensive. This shows you that we have embedded inflation in our system, in our economy today, that the Federal Reserve all of a sudden just wants to ignore. And that is a significant risk to hyper growth and hyperinflation and the return of the wage price spiral. Consumers are not stupid. They realize the only way to get protection or to even recover from bouts of inflation is to see their wages go higher. That's part of the reason you've seen so many union strikes over the past couple of months. I have a couple written in my notes here, if I can find it. Yeah. 32,000 Boeing workers agreed to a 35% pay increase over the next 4 years. That is an insane amount of wage inflation that's going to occur for 32,000 workers in the United States of America. And then you have the International Longshoremen's Association, who agreed to a 62% pay increase over the next 6 years. That equates to more than a 10% increase in wages every single year. And this is how it works. People get paid more money to make up for that inflation because they demand it. Otherwise, they just won't make ends meet. And as a result of that, prices for consumers go higher and things get more expensive, which makes consumers demand higher wages again, which makes prices go higher again. That's the wage price spiral that I'm kind of concerned we're headed towards again. And like I've said, it appears to me that the Federal Reserve, they're blinded to this somehow, where we have members of the Fed going out and saying, we haven't seen any reason to stop cutting rates, or they don't want to see labor market deteriorate further, or they expect additional rate cuts going forward. Yet all of these it's not even just the Federal Reserve that's stimulating the economy and threatening further inflation. It's also the fact that no matter who is our next president, Kamala Harris or Donald Trump, they're going to widen the budget deficit further, which is inflationary and stimulative to the economy. And then you have the fact that the United States Treasury Department, they're borrowing money at short-term rates to buy back debt at long-term rates in hopes to hold long-term interest rates lower. That is stimulative to the economy, which is inflation to the economy. You also have rising geopolitical tensions, which those certainly are inflationary. If the price of oil were to soar higher, the only reason oil prices have stayed low is because of weak global demand and the fact the United States has made up for a lot of lost production over in the Middle East. But you have those few things, and then the fact that most of our disinflation, I mean, I just showed you the chart, has come from CPI goods disinflation or even deflation. That's not going to last forever. The reason we've seen goods deflation is because the Chinese economy over there, they're trying to export their way out of recession, which means they're flooding the global economy with cheap goods or deflation, which has helped consumers in the United States of America. But that won't last forever. So if oil prices just start to rise higher because geopolitical tensions continue to get worse, and if the Chinese economy bottoms and starts to recover, those two major sources of disinflation in the CPI data will all of a sudden disappear. And then you're left with CPI services inflation, which continues to march higher and higher and higher. And you have a housing market that those shelter prices don't seem to be disinflating. That seems to be pretty sticky. And all of a sudden, you might have headline CPI that starts to tick higher towards the end of even this year. This chart shows you the estimate for GDP growth in Q3. As of today, the forecast for Q3 GDP growth is 3.4%. That is above the historical average of 3%. So just by looking at GDP alone, the Federal Reserve is set to stimulate or warm up an already hot economy, which again just makes that growth and inflation snowball grow bigger and bigger and bigger. And like I said, people aren't dumb. You can see based on these two different lines here, the red and blue line, this just basically shows you inflation expectations. You can see that these have started to uptick and trend much, much higher. Consumers are expecting further embedded inflation in the system for a lot of the reasons I've mentioned already in this video. And again, if that's the case, they start to demand wage increases to make up for that embedded inflation. And then that wage price spiral gets started. Not a good situation. Now, what's interesting about this is ever since the Federal Reserve decided to cut interest rates by 50 basis points to stimulate the economy, they had this knee-jerk reaction to a weak employment report, which on this channel we dove through. We were one of the first people to recognize that it had short-term aberrations in it caused by Hurricane Beryl that made landfall during the month. And the Federal Reserve failed to see that. And that's why I'm concerned again today. Is the Fed going to make the same mistake in thinking we have a labor market problem when in reality they're just short-term aberrations caused by the recent hurricanes we've seen or the union strikes we've seen? I don't know. And that's a risk we need to keep track of as investors. But what has happened since the Fed cut rates by 50 basis points is they've actually restricted the economy by cutting interest rates by 50 basis points. And that's because more and more people are starting to realize this might be a problem. We might have inflation kind of surge back to reality. And as a result of that, long-term interest rates will have to be higher. Again, no matter who's elected president, their policies will stimulate growth in the economy, which comes at the expense of inflation. Inflation also trends higher if growth trends higher. That's the snowball I keep mentioning. And as a result of that, this shows you the 10-year Treasury yield. Ever since the Fed cut interest rates by 50 basis points, it's actually, the 10-year Treasury has actually increased 50 basis points in yield, meaning if you want to borrow money, it costs you an extra 0.5% in interest to borrow that money, which means the economy's been restricted. Now, in a little bit, I'll get into the other scenario that I see playing out. But one last note I want to make is we called this out right away. The markets were way too overzealous about the prospects for rate cuts just a couple months ago. The markets were acting the same way going into 2024, and you can go back and watch my older videos. I talked about how I believe there would only be 2, maybe 3 interest rate cuts this year, and the markets at the time were pricing in 7 to 8. A similar thing happened after the Federal Reserve cut interest rates by 50 basis points, but all of a sudden, the economic data, it comes in better than expected, and the markets start to react and think, oh, we kind of mispriced this again. Current expectations are that the federal funds rate will fall to 3.5%, basically by the end of next year. Previously, expectations were that the federal funds rate would fall to 2.8% by the end of next year. So expectations have been reset higher a little bit, but I still think this is way too aggressive of an interest rate cutting regime if even this scenario plays out, which are the current expectations, the blue line on this chart. I don't think the economy needs this, and if this is what the economy gets, things are going to melt up. Inflation's going to become a problem again. We're probably going to see a hyperinflationary spell eventually towards the end of this decade, I would guess. And that's when things would break. But this thing can be, it can get bigger and bigger and bigger for years and years to come. Now, the other option isn't necessarily this inflation snowball, but it results in the same thing. The stock market trending higher as earnings growth continues, the economy stays really strong, companies do well. And as a result of that, valuations also continue to march higher. A lot of the problems that the bears have with the current market revolves around valuations and how whether you look at the Warren Buffett indicator or price to earnings multiples or price to sales multiples, any sort of valuation metric out there makes the current stock market look expensive, historically speaking. Now, there's a few different reasons for it, and depending on what indicator you use, there's some aberrations to the data as well, like the Warren Buffett indicator takes the United States GDP and compares that to the total market cap of the companies in the S&P 500 or something similar to that. The problem with the Buffett indicator is a lot of our largest companies have massive international businesses today. That did not used to be the case, and that kind of skews the data a little bit. But even further, we have to think of the current market and economic landscape we're in. Why would investors be willing to pay more per dollar of earnings for companies in the United States of America today? Well, it's because the risk of bankruptcies has declined as the risk of recessions has declined. You can look this up. Recessions are happening way less frequently, and when they do happen, they don't last near as long as they used to. In fact, the most recent recession was the Great Virus Crisis. That was the shortest recession in history. And a lot of that is because the Federal Reserve today is more active than it ever has been, as it has learned through history how to best prevent different financial crises from popping up in our economy and prevent those crises from morphing into credit crunches and economy-wide recessions. They've learned through history, just as investors have learned through history, how they've learned how to better maintain or better guide the country's monetary policy, their monetary path forward. There's basically nothing that's been thrown at them that they haven't been able to handle by throwing money at the system, stimulating the economy, cutting interest rates, introducing funding programs for banks to keep liquidity available, to keep the lending markets active. The Fed has learned how to do these things to keep this economy grinding on further and further and further. A lot of people have a problem with it. They think it's all rigged, and maybe it is rigged, but that's the reality of the situation. You can either get with it, or again, you can sit on the sidelines and be left behind. This is the reality of today. Now, eventually, it's going to become a problem. Eventually, the Federal Reserve will stimulate the economy. They'll throw way too much stimulus at the economy when we don't need it. And we probably will have runaway inflation, and at some point in the future that might happen. But I don't think we're anywhere close to that happening, especially when you consider, if interest rates go higher, our economy is way less interest rate sensitive than it used to be because of different shifts that have happened. We're much more of a services-centric economy today than before. In the 1950s, 2/3 of our economy, whether that's production, consumption, employment, investment, 2/3 of it was involved with the goods sector. That's flipped. Now 2/3 of it is focused on the services sector. And you think of services companies, they're much higher margin. They have much healthier balance sheets. They're way less debt dependent to grow. They don't have to build these massive industrial complexes. They're not forced to take out debt like the industrial giants of our past. So things have shifted in our economy that make our economy way less interest rate sensitive, which means even if the Federal Reserve is forced to keep interest rates higher for longer, it's probably not going to hamper economic activity near as much as it used to. So, that's going to be an interesting question. How does the Fed kind of start to tap the brakes on the economy if interest rates don't get the job done like they used to? That's a very interesting question to ponder. So, again, both scenarios that I see playing out result in, even if valuations continue to march higher and higher, it's probably partially is correct. There's less risk in the system of bankruptcies. There's less risk in the system of recessions, and it makes sense you'd be willing to pay more for companies in a less risky environment, right? So some of this premium that we're paying for companies is justified in a way from the Federal Reserve being so extremely active today. So with that, I want to leave you with an important message. I've said it already. But in my personal opinion, and I don't have a crystal ball, I could be completely wrong about everything I've said in today's video. Realize that's a possibility. That my track record's pretty good, but it also could mean that I'm due to be humbled, due to be corrected, right? So take this with a grain of salt, but I personally believe you have to get exposure to assets now. And the stock market is a beautiful place to do that because there is no minimum investment. You just have to get some sort of exposure so that you can benefit from a hyper growth or hyperinflationary cycle. You see, stocks have historically been the best inflation hedge because companies have embedded pricing power. So exposure to stocks gives you the best inflation hedge historically. But if you think our entire monetary system as a whole will fail in your lifetime, I would encourage you to get some sort of exposure to Bitcoin, some sort of exposure to gold, something like that. And that's something that I personally have done. So I'm not just speaking out of my rear end here. This is stuff that I have personally done. On that note, if you want access, I'm always doing research on companies and investment opportunities. If you want to be the first to know about them, that's one of those perks you get by joining the membership. So be sure to check out those perks. And if they intrigue you, just hit the join button or hit the Patreon link in my pinned comment. But with that, I'm going to end this video here. I hope you have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.